Nothing in this recording is intended as investment advice, and the people in this recording may hold positions in the companies they talk about. Do not make any investment based solely on a tip or recommendation. Please do your own research.
Hello and welcome to Zak's Traders Cafe. I'm joined once again by Michael Riedl, who's CEO, and William Green, who's CFO at Team Internet. How are you today, gents?
We're good. How are you, Zach?
I'm doing fine. We're speaking in the aftermath of this week's unaudited financial results from your company. And obviously, for people who are not aware, you're a global internet company that generates recurring revenue from creating meaningful and successful connections, businesses, domains, etc. But been one or two bumps in the road of late. Maybe I can start off with the CEO to ask you, Michael, about the G word, the elephant in the room in terms of your company, Google.
Right. Google is a very important trading partner of ours, the most significant in financial quantum, which first of all speaks to the quality of our business model. Google is so dominant in the global advertising industry because they have basically taken online advertising out of the dirty corner when 20 years ago, you would lose 50% of your advertising budget to fraud. Today, this percentage is way below 10%. This is basically enabled online advertising thriving to become the largest means of advertising, bigger than bigger than television, newspapers, and all other media together. And we're just in the middle of this industry. So how does Google affect us and in other businesses? So we operate this business called Tonic in Google, overcoming a specific problem. Google and search engines in general struggle to engage with Generation Z, Alpha, and the Generation Beta babies are still not on the internet, I guess. Because these generations love using social media, scrolling through their TikTok feed. However, these social media platforms, again, they struggle in converting the eyeballs into actual transactions. And this is where we come to play. We basically engage with these audiences on social media, whether it's Facebook or TikTok, and interest people for certain topics, like the 5 best life insurances available in your country, the best dentist in your town, redirect them from there to our properties. And on these properties, we basically show the ads that Google would have shown to the users if they would have been on Google rather than on TikTok. So this model has worked quite well. However, Google has seen that the way that they've basically designed the workflow back in 2006, when all of this was invented, is not really in line with what advertisers are looking for today. This is why they are materially overhauling their program, which was called AdSense for Domains. The new program is called Related Search on Content. Bit by bit, they are removing all customers, so all advertisers from AdSense for Domains. This is why here our old revenues with this business model come down. However, at the same time, our revenues with this new product, Related Search on Content, which has a much richer, much consumer and also advertiser-friendly appearance, is scaling up. In this process, we are very confident, I should say confident beyond doubt, that at the end of the day, the business should be just as big as it was, potentially bigger. And I'll come to that maybe in a minute after I take a short break. But the reason why our profits are negatively impacted is the old product was already honed to perfection, letting us extract healthy margins. This business is now, for the reasons given, coming down. Whereas with Related Search on Content, we have very strong product market fit. We see strong click prices. However, our algorithm is not just as optimized yet for this new workflow because consumers just interact with our websites differently than they did with the old websites. And here we need to plea for some patience. to basically let our algorithms learn from the new consumer behavior, letting us again grow the margins in that business to the levels where it was with the old business flow. And then we should see very healthy profits from this business again.
So, I mean, there are other factors of, what's happened already, and one of those factors is obviously the fall in the rating of the company, the fall in the share price and the market cap. Do you think that the market has already fully factored in, or maybe over factored in, the negatives that you've had to grapple with, and also under factoring in the potential for turning around and getting back on track?
I think this is a position that a reasonable person might take. If you just read through the most recent broker notes, most of them apply some of the part models. In these models, the search business is very much discounted, only looking in the rear mirror. What is the current profit run rate, applying very low multiples to it. But there's not any option value factored into this business. We have demonstrated that we can scale this business very quickly. When we acquired it at the end of 2019, we were doing $75 million of revenue from the former product, AdSense for Domains. We've then scaled it up within 4 years to a record of $500 million of revenue from this product. And there is no reason why, with related search on content, with RSOC, we could not achieve these numbers again. When you look just at the industry dynamics, the pool of advertisers that we can address is bigger than before, because everyone is opted in for related search on content. Whereas for AdSense for Domains, customers, so when I say customers, I'm speaking about advertisers, could already opt out of the program since 2008. And also on the supply side, so given that we need to buy users on other platforms, we also have an expansion of the total addressable market. So, for example, companies like TikTok have been a bit restricting the traffic flow to our ads, but now with related search on content, we see that they might be much more open to send more traffic into our direction, and therefore our assumption is that again, after 4 years of scaling this, it should be the same size as it was before. Hopefully we will be quicker than that, given that we don't have to reinvent the wheel in every aspect, only in a few, and that no one is factoring into the share price.
Right. We're obviously speaking, as I said, in the aftermath of results. Maybe it's a good time to speak to the CFO, William Green. What's your view of the position of the company at the moment?
Well, the position of the company is materially unchanged from the last time we updated the market in March. We've made very solid progress with the strategic imperatives that we laid out at that time. The earnings so far in the year have been in line with what we expected at that point, naturally with some variation in the mix between different segments. So the profitability of the company is, as I say, no materially changed from how it looked in March when we made our previous earnings announcement. One pleasing factor in the first half of the year is that we've managed to convert more than 100% of the operating profit that we've generated into operating cash flow. It's always been an annual and more regular target of the company to convert operating profit to operating cash at a rate of at least 100%. We've been successful in doing that in the first half of this year. That then raises the bar to carry that into the second half of the year, to continue to be as efficient as possible managing working capital, and indeed to continue to be ultra diligent in managing net debt. The net debt of the group already decreased from 109.9 million as of 30th of June 2024 to sub 100 million by the end of last year, and it's continued to decrease moderately through the first half of the year. So we need to make sure that we continue that in order that we can provide as robust a platform for the recovery of the search business and the continued growth of our domains and comparison businesses.
Just finally, there has been, obviously we're in an ongoing AI boom. How much is that affecting you, helping you, or hindering you in terms of what you're doing?
Right. So AI is an enabler of more efficiency in the business. It's an enabler to scale business. So, for example, the transition to RSOC would not have been thinkable without generative AI. You can't develop thousands of websites manually, and also for the internationalization of our comparison business. So here we've been very early jumping on the opportunity and growing our businesses using AI and making it more efficient. Given that we are talking to a UK audience here, and the Financial Times has expressed itself repeatedly during the summer quite negatively about the outlook for business that rely on Google, not as a monetization partner as we do, but for procuring traffic from Google. Here in the one business where we have this dependency, which is our comparison division, we've just demonstrated that for the last 24 months, which were all past the advent of ChatGPT and other chatbots, there was no adverse impact on the traffic volumes that we were able to procure from search engines. And I would rather say the most important thing that you need to deliver on the internet, whether there's AI or search engines or social media, is build a customer experience that customers love, and then they will come to you. And this is clearly the case for our comparison websites, on which millions of consumers currently predominantly in the German-speaking community rely on every year. So we shared the number 180 million visitors over the last 12 months. And now we're bringing that joy to other markets. So our US and UK properties are already live, so you could already shop there. And a little bit closer to Thanksgiving and the Black Week that comes with it, we will also go much stronger into the promotion. And we hope that many of your readers will not only be interested in buying our shares, but maybe also using our consumer guides.
Well, we look forward to that. In the meantime, Michael Riedl and William Green from Team Internet, thank you very much indeed.
Thank you, Zach.
Thank you, Zach.